Welcome to the Analysis and Interpretation section of Grade 12 Accounting. I'm going to use the Department of Basic Education Exemplar of 2014 to illustrate a few of the analysis and interpretation aspects. We are in particular going to look at question 5, and for question 5 we are going to start our focus on question 5.3, where we have to calculate the following financial indicators for 2013. The first one is the asset test ratio. Now, the asset test ratio is one of the ratios that focus on the liquidity of the business. So we have to focus on our current assets and current liabilities. In other words, the assets and liabilities that we can convert into cash within a very short period, namely within a year. So the asset test ratio, the formula is that we compare the current assets minus the inventory. Since inventory is one of the components of our current assets that is less easily convertible into cash. So we compare therefore current assets minus inventories as a ratio to our current liabilities. So if we go to the information that is provided in this question, which is a bit further below, we have to extract from the balance sheet for the year ended 31 August, and as we know, we are dealing with assets and liabilities. That's precisely the place where we will have to find the information. So we have our current assets section. We are interested in 2013. We have our total current assets, and amongst that we have the trading stock that we need to subtract. So we have 3,465,000 minus the 1,720,000. So we have 3,465,000 minus the 1,720,000. And that we have to express as a ratio, we say, to our current liabilities. So for 2013 we have our current liability section. It's 1,841,600. 1,841,600. Now, when we deal with ratios, we always want one on the right hand side. So we want to see how many current assets minus our inventories we have for every R1 of current liability. So that means both sides we have to divide by the 1,841,600. So we have 1,745,000. We divide it by the 1,846,600. And on the right hand side, if we divide anything by itself, it will give us 1 as is required. And now it will depend on until what decimals you round. If it's to 1 decimal, it will be 0,921. If it's 2 decimals, it will be 0,9521, which means we have 95 cents worth of current assets minus inventories for each R1 of liabilities. 5.3.2, we need to calculate the percentage return on average shareholders' equity. When we refer to return, it means it has to do with a profitability ratio. And when we think return, we think of the bottom line, which is the net profit after tax on our income statement. So on is our other clue. So net profit after tax is at the top on average shareholders equity. So we will just have to combine the 2 years shareholders equity and get the average of that. And since it's a percentage, we will also have to multiply by 100/1. So we have the return, which we said is the net profit after tax. So we have net profit after tax, our bottom line, and we have to divide by average shareholders equity. So net profit after tax, we said should be in the income statement. So let's browse down to find the details. Balance sheet, yes, extract from the income statement. So the net profit after tax is 1,820,000. 1,820,000. And we have to divide by the average shareholders equity. Shareholders equity we get in the balance sheet. So we need to browse up to average shareholders equity. So we have 11,011,400. 11,011,400. And we have to add to that the previous year's 8,595,000. 8,595,000. We need to divide by 2 to get the average. So if we divide by 2, we get the average. And then we will still have to multiply by 100 to get the percentage. So our final result is 18,5653. If we round to 1 decimal, it will be 18.6%. To 2 decimals, it will be 18.57%. So it will depend on where you round. 5.3.3, the debt equity ratio. It is a solvency ratio. So the debt we are looking at is the non-current liabilities. It's a long-term debt. So for each R1 of equity, we want to know what is our long-term debt. So long-term debt, so it's non-current liabilities to equity. So it's non-current liabilities as a ratio to equity. And our non-current liabilities we will find in our balance sheet account section, or in our balance sheet rather. So loan from Unity Bank is our long-term liabilities or non-current liabilities, so it's 3 million. And from the previous question we know our shareholders equity in 2013 was 11,011,400. So it's 3 million as a ratio to 11,400. We always want with ratios 1 on the right hand side, so we have to divide the right hand side by itself to get 1. What we do on the right hand side we have to do on the left hand side, so we have to take the 3 million and divide it by the 11,011,400. Then we get 0,27244. Now it will depend to how many places you round it. To one decimal it will be 0,3. To two decimals it will be 0,27. So for every 1 rand of equity we have 27 cents of long-term loans. 5.3.4, we need to determine the percentage return on average capital employed, and we are given the hint that we need to use net income before tax. So return, we know again refer to profitability ratios, and what's different in terms of 5.3.4 versus 5.3.2 is this time we have to determine that return on the capital employed and not shareholders' equity. So capital employed is the totality of the capital, not only owner's equity. So we finance our company not only via equity, but also we know via loans. That's another source of finance. So we need to combine the loans to the shareholders' equity. As the word average says, we again need to add up 2 years worth of equity and loans and divide by 2 to get the average. The return will now be the net profit before interest and income tax. So basically we want to extract the profit before referring to any financing costs, because we know the mixture of our capital will have an effect. For example, if you have only equity, you won't pay any interest, whereas if you have a high proportion of loans, you will pay a high proportion of interest. So we want to get rid of the various mixtures. That's why we look at the situation before the interest expense is taken into consideration. Okay, so our clue also is the on, so we know it's net profit before interest and tax will be at the top. Then at the bottom will be the average capital employed, and we multiply by 100 to get a percentage. So it is equal to the net profit before tax, and then we have to add back the interest expense, and that all we have to divide by the average capital employed, and then multiply by 100 to get the percentage. So let's just go and find the values. So profit, we know we look in our income statement, we are looking as per the net profit before tax, which is 2,600,000 rand. So we have 2,600,000. We know we have to add to that the interest expense, which is given as 462,000. You see, if you add these two back, you get to your operating profit, in fact. So we have to add the 462,000, and then we still have to divide by the average capital employed, and that we will find in our balance sheet. So we have to look at non-current liabilities, and specifically the long-term loans and the shareholders' equity. So we have 11,400 as shareholders' equity, and then we have this loan from Unity Bank, that's a long-term loan of 3 million. So we have to add those. Then for the other year, it's the 5,400,000 loan to the 8,595,000 shareholders' equity. So 11,400 plus 3 million. 11,400 plus 3 million. Then for the other year, we have 8,595,000. To that we still have to add the loan, which is 5,400,000. And we have to divide by 2 to get the average. And then we still have to multiply by 100 to get the percentage. So now it will depend to how many decimals you round. So if you round to 1 decimal, it will be 21.9%. If you round to 2 decimals, it will be 21.87%.